Welcome, everybody. This is George Veeder, Veeder Financial, touching base with you as we go around the corner to the end of the second quarter. Today's an exciting day. We have our Fed meeting. The announcement on interest rates has not been announced yet, but it's widely expected that we'll have a pause on interest rates after 10 um, consecutive raises. We'll have our first pause. And then the probability of a pause again in July is more than 50%. We know that we're at or near the top of the interest rate cycle. And the pause today, I think, will send a message to the market that that's the place that we're going. And that'll be a very positive thing for us as investors. Okay, we also have behind us, as we talk today, the debt ceiling bill. That was a pending disaster that didn't happen, as most pending disasters don't, that we worry about. That bill was signed, and so that's one possible negative consequence that's taken off the table. The other thing that has happened since we've had one of these conversations is we've wrapped up the first quarter earnings. It started in April and were concluded in May. We had a 78% beat rate on the S&P 500 stocks. That means that 8 out of 10 companies did better than what they had forecasted that they would do in the first quarter. So that's exceptional. Anything over a 60% beat rate is considered a very bullish sign. And again, we had a 78% beat rate over guidance. So we're totally excited about that. We also, in this period of time have survived a mini banking crisis. We talked about that last time, but we haven't had any new negative news or any new discovery. We still have 4,000 regional banks, and it was a very small niche of problems that we had with technology-focused regional banks. We had First Republic and Silicon Valley Bank and Signature Bank, and that's the containment of that little mini crisis. And it did play out the way we predicted it would, that the strong many would absorb the weak few. And that's the way that went down. So I'm trying to articulate the clouds that we've been staring at in the horizon and the ones that have dissipated to make our future look brighter as market participants. Now, the things that we have coming up, we have beyond the Fed announcement today, we have earnings in July and another Fed meeting in July to get through. Earnings, we're assuming, will continue to surprise us to the upside. That's been the trend for several quarters in a row. We're kind of prepared for bad earnings news. In fact, from April to April last year to this year, the expectation is that earnings would have gone down 6.6% year over year. They went down 2%. So there has been, an intended and an orchestrated slowdown in the economy to get a handle on inflation, but it's been much less than what we perceived that it would be or we were braced for. Also, I want to mention inflation data. We had the CPI, Consumer Price Index, and the PPI, Producer Price Index, that both were announced this week and were less than what was expected, which is good news for the Fed being able to back off from increasing interest rates. That's kind of gives him validation that he's done his job and that he doesn't have to keep doing that job of tightening. So that's really good news. Now, we have earnings in July, and then we also have the Fed meeting in July, and then we have that little short period of time, actually September, because earnings will go from July to August for the second quarter. In September, we typically have a kind of a dead spot, a flat spot. Historically, the Standard & Poor's has a track record to 1925. When we average out monthly returns, September has the lowest. In fact, it's the only month of the 12-month calendar that has a negative average. It's slightly negative over time on average. So I always tell people, if we're still holding on to cash, if we have too much in the bank or we went to cash and are still holding our cash there because we got scared, I will tell you that September is my favorite time to invest money and to prepare for the fourth quarter. So that's still going to be my mantra this year. If you have, change under the cushions in your couch, get it out and let's invest it in September. Because in October, talking crystal ball stuff now. We have an earnings season that starts for the third quarter, the second week of October. And historically, that catapults us into a very positive market trend, because by the time earnings go from October to November and they dry up, then we're into holiday sales that extend through Christmas, and then we have new pension contributions that fuel the market in January. So historically, again, using averages, December is our very highest yielding month on average since 1925 on the S&P. November is our second best yielding month, and January is our third best yielding month. So that rolling quarter is where we make a substantial amount of our money on average year. I think this year, I'm more excited than normal. Not only do we have that seasonal trend, but we're transitioning from a bear market to a bull market. I don't know, many of you have already heard the headline, but last Friday, the S&P met the definition for entering a new bull market. They're up 20% from their low in early October. Now, the definition of a bear market, negative market, is 20% down from the high, which we achieved in June of last year, a year ago. And the definition of a new bull market is when we come back up 20%, which we achieved last Friday. So by statistical definition, we're in a new bull market, and all the things that we were hoping for that would evolve in the economy some of them are already in place, and some of them look like they're going to get in place. So I just appreciate everybody having faith in our advice and our counsel, staying invested, believing in us during a scary moment. 2022 was definitely one of those scary moments. I'm very excited about moving into this next bull market and what's going to happen to all of our fortunes as we go through an expansion cycle that typically lasts 5 to 7 years. And we look forward to guiding you to, maximizing your returns during that period of time within the proper amount of risk. We just appreciate you. So grateful for the people that we get to serve, and we'll look forward to our next chat. Thanks.